the model here is not that this price necessarily reverts to the mean. The model here is that the monetary system is changing. So a lot of people look at something, a price run like that, and they say, well, that's overbought. That's a bubble. That's going to break. I don't want to buy it. I'm too late. And we see this in gold and we see it in Bitcoin. I see it particularly in the Bitcoin world. I have a lot of friends I've tried to convince on Bitcoin. They might get convinced and then they say, gee, Larry, that's great, but I got to pay 85 or 100,000. You were buying it at 5,000. And, I don't want to do that. I'm paying top price. And what I would suggest is that you turn this upside down and look at it as a slightly different thing. It's more like, the old monetary system was stable and the new monetary system is an avalanche. And we've had enough snowflakes fall that the avalanche is broken free and it's got a ways to run. Or said another way, consider the old monetary system is the Titanic and it's being transitioned and changed to a sounder monetary system. And the lifeboat seats are represented by gold and silver and Bitcoin. And so, so I bought some gold at $1,000 an ounce and I bought some Bitcoin at $5,000 a coin, and those are seats in the lifeboat. The cost to you today, you want gold, it's $3,300. You want Bitcoin, it's $85,000. Same seat as the one I bought, but it's more expensive because we're a little further down the road. So, okay, Mr. Investor, do you want to continue and hang out on the Titanic or do you want to pay more for the seat? Because if I'm right about the monetary system and it failing, we know that, if you had been on the Titanic and the same kind of thing had happened, it wouldn't have mattered what you had to pay for the seat. You wanted the goddamn seat because the alternative was terrible. So, it's being a little bit extreme, but perhaps not too much. I mean, this monetary system really is quite broken, and you need to read the book because the book talks about the history of these kinds of things. And, it may not go all the way to the Titanic sinking. I mean, we may just have really high inflation and a monetary reset, to be fair and to say that, but even in that case, gold and silver and Bitcoin will be an advantage to have over, all the other traditional assets. The dollar is a funny thing because it's measured really in all the other fiat. I mean, all the currencies are fiat, right? There's nobody who's on a sound money standard right now. So you're measuring the euro fiat against the the British fiat against the Chinese fiat against the American fiat. So I think the American fiat, if you look at the income statement and the balance sheet of most of those countries, I think the U.S. is just demonstrably in worse shape than all the others, but it's been the reserve currency, so it's enjoyed a premium. I think the dollar has a long way to fall. All of those currencies, I mean, what they represent is they represent currencies, things you can buy things in. Everything's priced in dollars. You can easily do a dollar price of anything, as you can with a euro. And the FX markets are very efficient, so you can move from one currency to the other. So to me, how the dollar does against the other currencies, I think it'll fall because it's overvalued compared to the other currencies. But what really matters is not that cross. What matters is the cross between the dollar and gold or the dollar and Bitcoin. I mean, I think, look, Bitcoin does not have, and gold, there are mechanisms for doing it. I just heard about one actually in Britain that was pretty cool for kind of keeping, Bitcoin in your account, or gold in your account, and then paying for things in dollars or pounds. But because switching from one to another is not hard, but most people have, currency accounts based on their local currency, and they pay for things in their local currency. And I think what will happen is kind of a mass version of Gresham's law, which says that people will, yes, you'll continue, the dollar will be around, we'll keep paying for things in dollars, but that won't be, nobody in their right mind will ever leave anything in dollars for very long because they'll know that they're melting, that they're losing value. And so to the degree you get paid or you have some savings, you'll instantly convert them into something that won't melt in value, and that's Gresham's law. The sound money, the bad money pushes out the good. People spend the money that's bad, the fiat currency, and they save on the money that's good, silver, gold, and Bitcoin. So, that to me is what's going to happen. But we're going to have a much more multipolar world, Kai, and I'm all for that. I mean, I think the U.S. has abused its privilege as the world's reserve currency. It's allowed us to conduct wars, do a lot of stuff that made no sense. So, having a more balanced regime of lots of currencies, and then with gold and perhaps Bitcoin as being the neutral reserve currencies, that'll be a better world, in my opinion.
I want to start with a mindset shift that I think every investor needs to hear. You are not buying Bitcoin at $85,000 or gold at $3,300. What you are doing is exchanging melting dollars for scarce lifeboat seats. This is not about catching the bottom or timing a top. This is about understanding that the Titanic is taking on water, and every moment you hesitate, those seats get more expensive. Now look, I get the hesitation. I hear it all the time. People tell me, Larry, I wish I bought Bitcoin when it was $5,000 or gold when it was under $1,000, but now it just feels too late. But that's viewing it through the wrong lens. This isn't a trade anymore. This isn't about FOMO or overbought RSI. This is about whether you want to be on the Titanic or in the lifeboat, because the ship is listing. It's not hypothetical. The monetary system is failing in real time. We've already covered in other conversations how the US debt spiral is terminal. With $37 trillion in debt, rising interest costs, and deficits north of $2 trillion annually, the US government has passed the point of no return. The only way out is inflation. The only lever left is money printing. And the endgame, the big print, isn't years away. It's quarters, maybe months. The signs are everywhere. But I want to take a step back from the debt math and zoom in on something deeper, the transition from one monetary regime to another. Because this is not just about US policy. This is a global reconfiguration. What's happening is that the world is shifting away from fiat currencies entirely. Not because it wants to, but because it has to. Think about it. Every major currency is now fiat. The euro, the yen, the pound, the yuan, the dollar. They're all backed by nothing, created by government decree and issued by central banks that are politically captured and now forced to monetize their government's dysfunction. So when we say the dollar is going down, we need to ask relative to what? Not relative to the euro, not the yen, not even the yuan, because they're all sinking ships too. What matters is how the dollar performs against something real. And by real, I mean gold, silver, Bitcoin, assets that can't be printed, inflated, or manipulated without consequence. Let me give you a mental model I've been using. Imagine the old monetary system is the Titanic, and it's slowly but surely going under. You've got lifeboats, gold, silver, and Bitcoin. Some people got into those lifeboats early. They paid $1,000 an ounce for gold. They bought Bitcoin at $5,000, and good for them. They saw the signs. Now it's later in the game. The bow is tilting, panic is starting to build, and the price of lifeboat seats is rising. Gold is $3,300. Bitcoin is $85,000. And people say, I don't want to pay that much. It feels like a top. But here's the point. You're not buying a peak. You're buying a seat on something that's going to survive. And if I offered you a seat off the Titanic for $3,300, would you complain? Or would you hand over your money and climb aboard? Because if I'm right, and I think I am, it won't matter whether you paid $85,000 or $125,000 for a Bitcoin. It won't matter whether gold cost you $2,000 or $4,000. What will matter is that you own something the system can't dilute. And let's talk about Bitcoin for a minute, because I know it's volatile. I know it scares people. But to me, Bitcoin is doing exactly what gold used to do. It's becoming the internet native escape valve from fiat failure. It's not perfect, it's not stable, but it's decentralized, it's scarce, and it's incorruptible. That's more than we can say for any central bank on the planet. And to those who say Bitcoin is too expensive now, I say the same thing I say about gold. You're measuring it in the wrong units. You're measuring a hard asset in units of a soft currency. That's like measuring the number of buckets you can use to catch rain in a monsoon. The rain keeps falling and your buckets are overflowing. At some point, you don't count buckets. You just ask, did I collect enough water to survive? This is why I also think we're seeing the early signs of Gresham's law playing out in slow motion. Remember Gresham's law? Bad money drives out good. People spend the currency that loses value, and they save the currency that holds value. That's what's starting to happen. People still transact in dollars, but nobody with a clue is saving in them. You get paid in dollars, and you immediately convert it into gold, into Bitcoin, into real estate, into anything that won't melt. And that's going to accelerate. Because once people lose faith in the purchasing power of money, they stop saving altogether, or they save in something else. That's how a fiat system dies. Not in one day, but over time, slowly, then suddenly. And we're already well past slowly. Now, some people say, well, this is just a dollar problem. The euro will survive. The yuan will gain market share. And maybe they're right to an extent. We are going to see a multipolar monetary system emerge. But let's be honest about what that means. It doesn't mean the yuan replaces the dollar. It means no single currency dominates. It means trade becomes more bilateral. It means central banks diversify reserves. It means gold gets remonetized quietly as a neutral collateral layer. And it means Bitcoin, whether you love it or hate it, plays a growing role as the non-sovereign digital asset of last resort. We're already seeing signs of this. BRICS nations accumulating gold at record levels. Russia and China settling more trade outside the dollar. Central banks adding Bitcoin to their watch lists. These aren't fringe behaviors anymore. These are the signals of an old system gasping for air. And just like with the Titanic, when it finally went vertical, there were no seats left. That's what we're heading toward. A repricing of everything. A rebalancing of trust. A return to monetary sanity, but only after the chaos.
Trump is doing with the tariffs, we're seeing foreign selling. And if you think about it, if a foreigner loses money, if a foreigner owns a U.S. stock and that stock goes down 10%, well, that's painful. They lose 10%. But if in turn, if the dollar goes down 10%, well, then they go to convert their dollars back to their home currency. And so now they've lost 20%. So yes, we're seeing foreign money coming out of the U.S. stock market. And I think that trend has quite a ways to run. But more importantly, just to answer your question about, let's define the sovereign debt bubble. So, this is what I call a death cycle or a death doom loop. And it's pretty straightforward. The federal government has $37 trillion in debt, and my book lays this out and shows you how rapidly that's grown. And then, as Powell pushed interest rates up to try and deal with the COVID inflation, interest expense has grown as well. So now the U.S. federal government spends close to $1.2 trillion a year on interest, just on the existing debt, and that's larger than the defense budget. That's a big number. And in turn, the U.S. government is running deficits, which they ran during COVID. You could explain that, as a crisis, but they kept running them post-COVID. You would have thought the spending would go down. It didn't. And so, last year's deficit was 1.8 trillion. This one's running to something over 2. And here's what happens. To cover that deficit, they have to sell bonds. They sell bonds into a bond market of a fixed size. If you come to sell more, if there's more supply of bonds and the same number of buyers, then the price of the bond, the interest rate on the bond has to go up to entice people to buy them. That interest rate going up is what the federal government then has to pay on all the existing bonds as they roll over. That then makes the 1.2 trillion of interest expense become a bigger number in the following year. That then makes the deficit become a bigger number. That then means they got to sell more bonds. And you see where I'm going here? You've got kind of a negative feedback loop that really is at the core of the problem. And in fact, it was the U.S. 10-year moving from, when they first announced the tariffs, the stock market went down and the bond market did what it traditionally did. It was a safe haven and it rallied, and that looked good. That was kind of what Dissent probably wanted. But that rally didn't last very long, and pretty soon people started selling the bonds too. And I think the reason for that is people realize that the stock market going down will decrease tax revenues, will increase social payments, and deficits will get ever larger. And so, this is a problem that, it's hard. It's Lynn Alden's meme. Nothing stops this train. It's very hard to reverse this cycle that we're in. And that's what's really leading to the sovereign debt crisis. And so, where it ends, we don't know. We can map out a lot of possibilities. The book does that. I give you a lot of scenarios, but it certainly doesn't end in less inflation. I'll say that with a high level of confidence. So he's really trapped. I mean, he really is. I mean, he should have resigned a long time ago. I wouldn't want his job.
For $180,000 a year, you got all the headache, right?
Yeah, right. Well, he's got 100 million plus net worth. So like I say, he doesn't need it. But as we know, ego drives people to do these things. But anyway, I don't know, honestly. I mean, they know they're running out of runway in terms of the ability of the monetary system to handle the debt. And I'll give you a couple of data points on that. First is they, at the last Fed meeting, they took the quantitative tightening, which is shrinking their balance sheet and reducing the money supply, or at least reducing reserves, which have the effect of reducing the money supply. They took that from 25 a month to 5. I thought that was interesting.
So let's pick up right where we left off. The Titanic's already taken on water, and the lifeboats are being launched. The cost of those seats, gold, Bitcoin, silver, is rising. But most people are still dancing on the deck, listening to the orchestra, trusting the captain. That's the nature of monetary shifts. The public is always the last to know. And when they do realize it, they rush for the exits. And the exits are small. Let's talk about that exit window because it's shrinking. Once central banks move from merely easing to full-blown yield curve control and coordinated money printing, the clock starts ticking for real. This is the moment I call the big print, and it's not far off. In fact, if you're reading the signs, it's already underway in the background. They're not calling it QE yet, but they're prepping the markets, laying the rhetorical tracks. You've got the Fed cutting QT from $60 billion a month to $25 billion, and then recently to $5 billion. They're already in stealth mode. They'll say it's to support market function or enhance liquidity transmission. But let's call it what it is, a soft pivot back to monetization. And it's going to accelerate. Because once the bond market seizes up again, or the stock market loses 30%, the Fed will have no choice. They'll print to suppress yields. They'll print to fund the Treasury. They'll print to support pensions. And eventually they'll print to prevent a full-blown social crisis. Because we're not talking about 2008 anymore. We're talking about the credibility of the entire system. And when the big print becomes official, two things will happen simultaneously. First, real assets will moon. Gold isn't going to rally. It's going to be repriced. That's different. A rally is a speculative move. A reprice is a structural reset. And that's what happens when central banks permanently surrender to inflation. You'll wake up and see gold gap up $400, Bitcoin up $10,000, then another $20,000 the next week. That's not hyperbole. That's what repricing looks like when the marginal buyer is the system itself, trying to restore trust. Second, trust in fiat dies. Not instantly, but permanently. People will still use dollars, sure, but they'll stop holding them. They'll pay bills in dollars. But the moment their paycheck clears, they'll convert the rest into gold, into Bitcoin, into something, anything that's scarce. That's Gresham's law. Bad money gets spent, good money gets saved. And we are entering the final phase of fiat, where bad money is all that's left to transact in. This is also when we'll see the political system kick into overdrive. You'll hear populist calls for stimulus, for price controls, for emergency fiscal transfers. All of it funded by new money creation, and with it, more capital flight, more asset repricing, more panic. At that point, the US dollar's status as global reserve currency becomes a liability, not an asset. It invites scrutiny. It exposes the US to capital withdrawal. It weakens the geopolitical advantage we've used since Bretton Woods. And the world responds, not with war, but with currency realignment. Let's talk about what that looks like. The BRICS, already laying the groundwork for an alternative system, move toward a commodity settlement unit. Maybe it's gold-linked. Maybe it's a mix of oil, metals, and food exports. Maybe it includes Bitcoin at the margin. But it's outside of SWIFT, outside of the dollar. It's a parallel system, and it's already here. Countries start building bilateral trade deals based on local currencies or gold. Central banks quietly increase their allocation to gold beyond the 20% we're already seeing. You'll see digital currencies from sovereigns, but none of them will be trusted unless they're backed by something real. And this is when gold gets remonetized, not by decree, but by behavior. The world won't return to a gold standard with some formal vote. That's not how it works. It will happen by necessity. Gold will be used in clearing, in central bank swaps, in bilateral settlement. And soon people will realize this is the asset that actually functions as money. Not credit, not paper, not even digital debt tokens. Real value, tangible, immutable. Now let's circle back to the investor, because all of this sounds abstract until it hits your retirement account, your savings, your grocery bill. What does this look like in your life? If you're holding cash or bonds, you're losing purchasing power daily. Not gradually, not theoretically. In real terms, your money is melting. A 5% yield on a treasury means nothing if inflation is running 8%. That's a guaranteed loss. It's theft wearing a necktie. If you're holding stocks, you might ride a wave, but the PE ratios of the last decade were built on zero rates. That era is gone. Companies that rely on cheap financing, on rollovers, on debt-fueled buybacks, they're in trouble. You want real cash flows, real assets, real pricing power. But more than anything, you want ownership of the things the system can't dilute. And that means gold, the 5,000-year-old monetary base layer, now making all-time highs against every currency in the world. Bitcoin, the digital reserve asset of the 21st century with finite supply and borderless transferability. Silver, the industrial and monetary hybrid that will move when inflation and commodity demand collide. Are these assets volatile? Yes. Are they guaranteed to go up in a straight line? Number. But are they rational places to store value in a system that's about to debase itself into oblivion? Absolutely. People often ask me, "What's your endgame, Larry? What's your time horizon?" And I tell them, I don't have a price target, I have a trust target. Because this isn't about $5,000 gold or 250,000 Bitcoin. This is about the moment trust in fiat ends. And when that happens, price discovery breaks. You'll see offers pulled, bid-ask spreads widen, and people won't be selling gold. They'll be looking to buy at any price. And that's when the regret will come. The regret of not buying sooner, not acting when you could. Because the hardest time to buy sound money is when you need it the most. So here's my final message. You don't need to guess the exact moment of the collapse. You don't need to time the peak. All you need to do is understand the direction of travel. The monetary system is changing, fiat is dying, and a new regime, one based on sound, scarce, decentralized assets, is being born. You can ride the Titanic down with everyone else, or you can get a seat on the lifeboat. Just know this, the cost of that seat goes up the longer you wait. And when the panic starts, there won't be enough for everyone. Choose wisely, because this isn't just a market cycle. This is a once-in-a-century transition. And those who understand it now, before it becomes obvious, will be the ones who don't just survive the reset, they'll lead the next era.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.